Okay, we will kick off. So I think we've just gone 12:02. So ladies and gentlemen, welcome and thank you for joining us today. Welcome to our Lunch and Learn workshop with a little twist with a wine, we've called it this time around. So if you've got your glass of wine, fantastic. I know Adam and Will have got their glasses of wine as well, which is great. If you want to grab a cup of tea, grab a glass of wine, please do so. Yeah, good to see, mate. Good to see. My name is Paul Jansen. Welcome. We're here thanks to Virtual Financial Advice, and I'm here with Adam Besarovic, their CEO and founder of Virtual Financial. How are you, mate? You good?
Good, thanks, mate. Good, thanks. Looking forward to it.
Yeah, it's going to be good. Now, for all of you that have joined us, we've designed these workshops mainly for you. So this is all about educational learning, let's call it, into the investment world. What sort of different opportunities are out there that we can share with you? We did this last year. It was very popular. If you did miss anything that we did last year, please go to Google, type in YouTube, type in Virtual Financial, and you'll see all of these recordings on our YouTube channel. While we're there as well, I'll just share something else we did last year as well that was very popular. It was called our Talking Numbers podcast series. So we did a Talking Numbers Property Plus, which was all about property investments. And we also did a Talking Numbers Investment Plus. And Adam and I went into a fair bit of detail. It's a 6-part series. We're soon to record our second series, which again is all on our YouTube channel. Now, this Lunch and Learn workshop, it's going to be fun. We're going to talk about some different things, and I'm going to let Adam introduce Will Simpson very shortly, who is our guest. But we're going to talk about what's known as an anti-fragile portfolio framework. Now, let me give you a bit of an idea of my little bit of research on this, because I think it's important that we sort of look at this. It's about how we keep things fairly simple, but look at the balance between, let's say, safe investments and let your portfolio grow, and then some of the more higher risk investments with some, let's call it, the areas we're going to look at is probably, let's say, that disruptive space. Let's call it the sustainability space. We know the Web 3.0 is still, it's a fast developing space. We know artificial intelligence or AI. I don't know if anyone else uses ChatGPT, but I know I do. It is gathering speed like you wouldn't believe. So we'll delve a little bit into probably, while we'll talk about disruptive and while we'll talk about sustainability, we'll also delve into things that are affecting our lives right now and probably what we can look at in the future as well. Adam, I might hand over to you, mate, to welcome everybody, because they're all Virtual Financial Advice clients, exactly. Number one. And number two, your relationship with Will Simpson. So I'll let you introduce Will.
Thanks, Paul. Much appreciated. Look, today is all about helping our clients, educating our clients. I want our clients to see what other people that are wealthy, that are rich, what are they doing? How are they investing? You know, all these clients that have all these investments are normally only the people who've got big money that could $500,000 to invest in a wholesale fund like what Will has at Blue Oceans. You normally need at least $500,000 to invest in this fund. Through our dealer group, we've been very, we've done I suppose a partnership with Will where our clients from $50,000 and upwards can invest in such a fantastic opportunity. So it's to give our clients the opportunity to invest in alternative assets. So, today, we've got Will from Blue Oceans talking. Next month, we'll have Nick from the Charters talking. Then we've got the property series. So it's all about educating our clients and trying to help our clients create as much wealth as possible. So Will's on the approved list at Chartreuse. The advice we'll be giving today is all general advice. So we're not taking into account your personal circumstances. There's no plan being done here today. If you do wish to invest in Blue Oceans, please contact our office, and then obviously we'll have to do a statement of advice and etc. But Will's got the business Blue Oceans. I believe it's a terrific fund where they invest in between 8 and 14 funds of the best companies across the world, and the way they do it really is really interesting. So Will, over to you, mate. I'll let you kind of explain it in more detail.
What I might do is, before Will does that,
sure,
we might welcome Will. And Will, if you've got, maybe you can give us a quick 30 to 60 seconds about yourself, a little bit about your background, so everybody knows before we kick off and get into this. Tell us a little bit about you, mate.
Yeah, sure. No, thanks for that. Thanks for the introduction, Adam. So I kicked off Blue Oceans Capital, founded Blue Oceans Capital in July 2016. Really, what I'd done is I'd spent some time investing myself. I'd spent some time studying finance. And really what was apparent to me was that the way finance had been implemented worldwide by mainstream fund managers was all much the same. And it's typically an approach to risk which really has a crutch on taking statistical risks over doing fundamental analysis. So to break that down, really what I mean is that most fund managers out there are invested in 50 to 100 stocks. They're not putting their analytical skills on the line for individual companies. So if you've got an individual company that's only 1, 2, maximum 3%, maybe 5% of portfolio, and it goes bad, it doesn't affect their overall performance. So that sounds good from a risk mitigation perspective, but what it's not doing is delivering those investors any real chance of alpha, any real chance of outperforming an index. And my argument would be that that those investors are potentially better off just investing in an index without the management fees.
Okay, interesting. And that's what we're going to sort of delve a little bit deeper into, which is going to be fantastic. So thank you, mate, and great to have you here. So we're going to be running this for probably the next, what are we at? We're 12:08, probably the next half an hour or so. If you've got any questions as we go along, please throw them into the Q&A bar that's below you there. So any questions you've got, throw them in there, and we are allowing time for questions at the end of this. So please do so. All right, Will, let's get into this. So, mate, sustainability and sound investments, how do they go hand in hand?
Yeah, sure. So let's have a look at that. So, we've all witnessed some extreme changes in the world over the last 3 years, just absolutely unprecedented change. But with that change has come tremendous opportunity. We all saw in 2020 the major rise in tech companies. As we had this absolute existential threat, which demanded that we massively upgrade our technology infrastructure. We had to have it at that day. And we saw the valuations of companies that were providing solutions to that need just explode. So, our portfolio itself went up by about 80% in 2020. Now we've rolled into 2022, I would call a commodities boom year. Those tech companies came down, that money went into energy companies who had a great year. And now this year we've seen that roll through again, where a lot of prices of commodities have now come down to their pre-2020 levels. So tremendous amount of change, but in amongst all these moving parts, as I've just explained, there's been huge opportunities for investment. So that's what I'm talking about. When I mention anti-fragility, I'm really saying building a portfolio that's recognizing what's happening in the world today and that actually is benefiting from it. So we had the words risk mentioned a couple of times in the opening there, and I just want to break down what that means, because, and if we take a step back from that, which we've also mentioned the term sustainability. Now, that's a pretty loaded term out there in the market today, and there's lots of really good reasons for that. And one of the things is that sustainability means a lot of different things to different people. But I think if we were to unpack it a little bit more, what it really means to me and what's taught at Harvard Business School is that sustainability when it comes to investing is about analyzing long-term operational risks. So if I bring this back to just a core investment perspective that leaves philosophy on the shelf, ideology on the shelf, what we're really talking about is finding those investments that have a high probability of outperformance with really actually a quite low level of risk. Now, if we just focus on risk for another couple of minutes, what's the risk of, so we're talking about sustainability and sound investments. Risk comes back to in my mind, to valuation. Okay, so for any investment to work out, you have to have a sound valuation. To have a sound valuation, you need to make some assumptions about cash flow production into the future. So for those cash flows to come into reality in the future, the business is going to have to exist in the future. So what I'm talking about there is about coming back to the actual business model analysis. Is this a business model which is actually going to gain from the disruption which we know is going to happen and is happening right now? And is it a business model that's solving a problem that has got some longevity to it? So, will the cash flows which we're projecting into the future, as analysts, we have to do this, actually come into reality? Because if it's on the wrong side of disruption, they may not come into reality.
Okay, so really interesting that you mentioned. I'm going to jump into the business models very soon, and we'll talk about some. Let's talk about some positive changes that have come into play, and then what type of businesses. But you also mentioned an interesting one, which was energy. Now, we all know, if we're all living in Australia, we all know the cost of what energy is costing us right now. So, is that the sort of thing that you're talking about? It's a good point, isn't it, that you just raised?
Yeah, that's one of the more obvious examples is energy. And, one of the biggest position in our portfolio is a solar inverter manufacturer has been growing at over 50% per annum since 2018. So it's compounded away to huge levels now. And, if we just talk a little bit about some of the drivers, and I mean, we're all probably aware of these things, but just to highlight them, I mean, case in point, the American Inflation Reduction Act. So that's 530 billion Australian dollars of stimulus that is only directed towards sustainable investment initiatives. They're needing to roll out EV charging infrastructure throughout America. They need to have their own domestic production of solar power. They need to develop their own domestic production of hydrogen power. And what that did was, though, is that created ripples around the world because it's $500 billion. So what that meant was that a manufacturer in Europe looking to build a new factory no longer wanted to build it in Eastern Europe. They wanted to build it in America because that's where they had to be. They had to start a PTY Ltd in America to be able to benefit from that act. So the European Union now is seeing this happen now, this sort of fleet of capital to the States. And so they've now got a 360 billion euro fund where they're creating their own incentives for domestic sustainable energy initiatives there. So, and of course, just last week here in Australia, we had a policy come into play, which it'll be enacted on the 1st of July, which means that 214 of Australia's biggest emitters are going to have to commit to reducing their carbon emissions by, I think it's 4.8% per annum. So, we speak about risk. Where is the risk? Is the risk on the side of sustainability or long-term operating risks, or is it on the side of stranded assets, which could come about?
Yeah, you're right.
So by stranded assets, I mean those companies which are on the wrong side of regulation, and whether we agree with sustainability or not, and it actually doesn't matter because it's happening whether we like it or not. And so when we think of our investments and performance, we have to consider this no matter our political ideology, because there's been some reversion while we've had this energy crisis, and we do have to. I mean, it would be my personal opinion. We have to keep fossil fuels going for possibly the rest of my lifetime. But in terms of like investing big amounts in new capital outlays in terms of fossil fuel infrastructure, those companies don't want to do it because they know regulation is not on their side, that they might not get their money back on those investments. So when they're doing their financial modeling and saying, will we invest $5 billion in more oil and gas infrastructure, and doing their cash flows out for 10 years on their modeling, they know they might only get to year 4 or 5. Like, what's going to happen in 2030 on those assets? So stranded means is that those assets actually won't have any cash flow production. They'll be cut off, for example, by regulatory initiatives.
Interesting. And then I suppose the more recent one, not that I want to go into it, but we're sort of listening to the noise in the media, let's call it. That's why I want to get into some positive changes of other business models and what type of businesses they are. But if we look at even the announcement, I don't know, between the US, UK, and Australian governments for the building of the nuclear subs, as an example. So again, that's in the news, which makes me think about the nuclear energy side as well. So let's get into some of the stuff that you may want to, and you may want to even touch on that as well. But there's something that those are going to be built in 20, 30, 50 years. So those are the sorts of things that you're talking about as sustainability as well.
Sure, yeah. So I mean, like, I think one thing that we all want to keep in mind is are we investing or are we speculating? So if you're speculating, you perhaps aren't so worried about the financial return of a business. You may have some idea that this business is going to be producing high amounts of cash flow in the future, or that may not even matter. You may just feel that the market has a lot of momentum behind an investment. When you're investing, then you're actually doing a valuation on a company, and you're actually moving into something which is at a lower price than what the market values it at, and you expect to stay with it for at least 1, 2, 5 years or more. So when it comes to something like a nuclear power energy, sure, there's a tick on the box and that it perhaps is going to be on the right side of change. But in terms of an investment, well, what I would argue, and this sort of simplifies a lot of the way we think about companies, is that's a very capital intensive company. So its return on how much it has to spend on infrastructure ends up being quite low. So this is how we think about companies, and it just comes back to risk. In terms of companies that are low margin, high capital intensity, can find themselves in difficulty of being not profitable in time. So we would exclude that just on a quality perspective. Yeah. But the great thing is, right, so is that there's lots of companies which are really on this right side of transition, have got terrific fundamentals behind them, which are undeniable. So I've mentioned a couple of examples in terms of regulatory already, but they don't even need it. So solar industry, for example, is profitable without subsidies now and has been for some years. And it is even before 2022, when there was the coal price, commodities boom, etc. It was even for many years now. So if I come back to an example of Solar Edge, so I've already mentioned once before, it is the biggest part of our portfolio. That company has a return, so on its invested capital. So if that makes, so return means, let's just call it net income on how much money is being spent to produce that net income. So it's a return of 20%. So just to put that in some perspective, you've got Shopify, which a lot of people will be familiar with, negative 1.72. Shopify loses money, not just this year, has been for 5 years. Amazon 9.8. Wesfarmers here at home 10, BHP 14. So this company has got all of those tailwinds behind it. It's the biggest inverter manufacturer in the world. It's across the USA, Europe, Australia. So it's in all these markets that have the regulatory tailwinds behind them. Not that it needs it. It's already a lower cost production than other energy alternatives. And it's got this internal rate of return that's higher than many companies out there in the market. 20% is very high. So we look at every company on global exchanges, excluding emerging markets. So just a side note of that, the reason we do that is because we need to know that we've invested in the best opportunities possible. To know that, we have to look at every opportunity. So when we're able to select our companies, we actually know that they're the best performing investments available to us. So we know that 20% return on invested capital is a good return. But that's a company that's, like I said, been growing over 50% per annum since 2018. I think it's even longer than that. But even at the scale it's reached, compounding at that level, it still has an enormous growth to grow, an enormous market to grow, and a growing market to grow into. So when we start to think about risk, and right now, I mean, in terms of our valuation, it's at least 30%. That's a very conservative valuation. Solar, I'm not suggesting anyone run out there and buy it, but just on our valuation, it's at least 30% undervalued. So where the market is today, after we've had this whole tumultuous time discussing inflation, will there be a recession, will there not be a recession? We've had a lot of shocks and in the stock market now going on a year and a half, really since November 2021. Now, and whether you invest in me or not, or just put your money in index, I'm not trying to convince people. I'm just saying that now valuations are quite good, and that there's a lot of compelling opportunities out there that are actually what we would see as low risk, high value.
Brilliant. So let's talk about the less risky ones then. What other sustainable business models are out there that are inherently less risky?
Yeah. Well, So exactly the whole theme of what we've been saying. So we would argue that these business models that are leveraging on the right side of change here are less risky. And I think one way to sort of in your mind, if sustainability means conflicting things in your mind, is think, is an unsustainable company less risky? Yeah, is this just, so when you start thinking about that, well, it starts to force your brain to think about what does sustainability mean to me. And I think it's probably a good thing for people just to try and put all the woke ideology, the philosophical ideology on the shelf, and just think about long-term operating risk here. If you're an investor, if you're a speculator, then there's a totally different case. That you may think that oil markets present some, short-term opportunity. That's a totally different. That's not what we're here discussing today. And I don't think sustainability has a big relevance in that kind of speculating. It may not short-term type of investment, but in a longer-term investment, it absolutely does because of long-term operating risks. So let me just take you through a couple of examples we have in our portfolio. So another one which is really interesting is a company called DocGo. So this is an ambulance provider in the US. So what they do is that they not only provide private ambulance service, they take healthcare into the home. So what they do is they upskill ambulance drivers, paramedics. They upskill paramedics to be able to do a lot of routine tasks that doctors do, like give an injection and dispense pharmaceuticals. So what they'll do is actually a little bit like virtual financial, okay? So they actually go take the paramedic in with a camera, and on the camera is a doctor, a trained doctor profession in the specialty that patient needs. And so they will be able to dramatically reduce the cost of care by having the doctor there virtually, being able to see 3 times, I think it is 3 times as many clients in an hour as they normally would. So they're there on their rate. And then you've got the paramedic there able to, under the doctor's instructions, give an injection or dispense a medication because they've equipped technology in their vans that automatically dispenses the medication under the doctor's prescription. So they are dramatically cutting the cost of healthcare in the US. And I mean, a lot of the listeners will be aware that healthcare in the United States is one of the biggest spends. It's crippling the country. So that is a company that's undervalued right now. They picked up a lot of business during COVID. And so when analysts do a 30-second look at DocGo, they see COVID revenue, they see its growth has gone flat, and they don't invest in it. But if you take more time and have a look under the hood, what's actually happening is DocGo is replacing that COVID revenue and staying flat, which is remarkable because they were growing over 100%, 150% per annum during the COVID years. They're now replacing all that COVID revenue with non-COVID revenue and growing and staying flat. So in this next couple of quarters, they'll actually start to show their true growth rate and start to tip up. So what we can find with some of these companies is that we can actually do a valuation and buy them at a price which represents a zero cost of future growth. I'll talk a little bit more about that in a bit when we speak about one of our recent investments.
Yeah. Okay. So DocGo, Solar Edge, I just had a quick look at both of them. So it's always good to jump online and have a look, which is good. Now let's talk about some of what's an opportunity, let's say a larger opportunity in this sustainability space.
A larger opportunity.
Yeah. Is there something that you could talk about in terms of large opportunities in the sustainable small caps?
Oh, more generally. Yeah. So we're seeing, so like I said, we look at sort of over 30,000 companies every 3 months. So we're seeing where the growth is worldwide. And one area that's particularly exploding, perhaps not surprisingly, is in electric vehicle chargers. So, and I mentioned charging over, say, car manufacturers because they also tend to have fairly good unit economics as well. So we see a lot of growth there. We see a lot of growth in solar, of course, in battery manufacturing, but also and just moving away from the obvious. There's good growth in companies in software companies that make business processes more efficient. Now you have to be picking the right companies with the right financials. A lot of tech companies spend so much on R&D, so much on engineers, they're never profitable. But when you find those ones that provide some niche software that have the good unit economics, you can really get onto a multi-year winner. So one example there, just quickly, just because this is a good example, because it's maybe just gets people thinking outside of what sustainability, generically means, because we can just be talking about a company that makes the cost of doing business cheaper. So one company that we're invested in is called Paycom, and this is just digital human resource management. So the story there is that, it's able to dramatically lower the cost of HR to major organizations. And this company has been around since 2003 or 2004, I think is when it was established. And Paycom is it's an every year, hits the ball out of the park, just constant every year slugger, like over 35% growth per annum, year in, year out. And the manager there grows that company within its means. And by that, I mean is that they always have a strong operating margin. He never takes that margin and invests all of it on marketing. It just grows within those unit economics every year and just keeps stepping up. Another company similar that we're invested in is Ardian, which is a global payments provider. So they take the friction out of global payments. They make GDPR, which is the European Data Privacy Protection Act, possible, because that's a very complex set of regulations. But this company is just well managed, grows within its means, just like Paycom. And the way that compounding works, when we invested in Ardian, just in 2018, I think they had like 1.2 billion euros on their balance sheet. And now I've got 6.5 billion euros on their balance sheet. That means this year, with the way interest rates are, they're going to make over 150 million euros just off interest. So is that a risky company? And if you look at the valuation right now, it's compelling as well.
Brilliant. Adam, I might just throw to you, mate. You got anything that you'd like to add into that?
Yeah, look, it's very interesting, Will's comments, in regards to, those 4 or 5 companies he's mentioned. I mean, I think the other thing that really impressed me was that most of those companies have close to $1 billion of cash in the bank. So it's, you're talking about the top shelf companies in the world, that really are the best of what they do. Their cash flow is incredible. The opportunities for our clients to be able to invest in these sort of companies is just second to none. And you know what, this is where, as I said before, where the rich and wealthy are investing, where, people that are, that have enough funds to be paying their financial advisor 50 or 100,000 a year, these big firms get to invest in. It's great for our clients to be able to invest if they're able to in these sort of, or at least have the knowledge and have the information, so they maybe in 2 or 3 years' time when they can invest, there might be opportunities for them going forward. I mean, I just really love the idea of the fund and how there's only, at the moment, I think, Will, there's only 8 funds you've got invested at the moment. Is that correct?
In terms of number of stocks that we're invested in, we've just moved up to 10 stocks. Yeah,
10, sorry. So 10 stocks. So yeah, so you focus on quality, and that's what it's all about. So it's just a fantastic fund, and I really see, looking at the future, I really see some good times in the next, 2 to 5 years. I think there's a real opportunity for people to be investing now. Obviously, we don't know what's going to happen in the next 5 minutes or 5 months, but I think long term, 5 to 10 years, I think if you invest for the long term, I think there's some really, really good days ahead.
Well said, mate. Well said. Well, let's chat. You mentioned one of the investments that you just got into. So maybe if you can take us through one of those new investments. I think is it InCap?
Yeah, that's a good one to mention. So we've only just invested in InCap in the last month. And this is an interesting one to kind of make a case in point about wrapping up the whole discussion. So InCap is a manufacturer. So they produce printed circuit boards that go into electric vehicles, but also into sustainable energy. So they go into solar inverters and in throughout Europe. So on a glance, we might sort of be thinking, okay, tick that this company is benefiting on the right side of disruption, but big cross because it's a manufacturer of a commodity-based sort of product. What's the difference between one printed circuit board and another? So what's really unique about InCap is its net margins. So InCap has net margins. So what I mean by that is just it's income, net income divided by revenue. Okay, so for InCap, that's 10%. And for all of its other competitors, it's 3 to 5%. So they have double the profitability of their competitors. So that's what makes it really interesting. And so how is that? How has it done that? So the way Incap's done that is that they have factories around the world which produce these printed circuit boards. But what they do is that they let each of the employees in the factory make their own decisions. So it has this decentralized management. So the employees in the factory actually negotiate terms of contracts themselves with the clients. So, and they're responsible for the unit economics of their factory. So it gives them ownership, it makes them accountable, and they're incentivized off the profitability of each factory. So they're working for themselves, which makes them just so enthusiastically excited about going to work every day, as opposed to all of the other competitors where management is responsible for all those decisions. So there's two big things there: engagement levels of employees, plus the overhead of management. So for Incap, they can run this whole $500 million company with 3 management personnel. So that's where they make the difference. The other big thing that happens there is that in that game, printed circuit boards, the winner is speed to market. So with the employees in these factories having the ability to settle a contract right there and then in the meeting, not have to wait for approval from head office, they get it done straight away. So Incap's been growing 50% per annum. They've just made infrastructure investments last year that will double the throughput of their factories and their factory size. And it's with those net margins, they're able to go out there and be able to spend more on more of these production capacity expansions than any of their competitors, because obviously they've got more cash flow per unit than any of their competitors. Yeah. So that's what they're doing. Plus, they're able to have more cash coming through on the balance sheet to buy other companies and expand their model into those companies. So that's what they're doing as well. They're out there hunting for another acquisition right now. The size they're looking for will be about a 50% of where their revenues are right now. And it's a small cap, right? So one thing for the viewers, a small cap by definition is a company sort of anywhere between 500 or less million to 2 billion. So Incap's about 500 million euros I'm talking about. So small caps are inherently cheaper than large caps because institutions can't buy them, right? If you've got 10 million under management, 10 billion under management, you're trying to invest in 100 companies, you're trying to put in 100 million into an individual small cap. You can't do it because you're going to blow the market price out of the water. So for us individual investors, small caps are an open field just for us. And these companies typically not only are cheaper, but they're growing faster than large caps too, because they're just moving into their total addressable market and haven't already captured it all. So, and especially in Europe right now, because of the political situation over there and the tensions around inflation and those sorts of issues, small caps have come right off as well. So we were able to, so when I talked about valuation and how we predict those cash flows into the future, we were able to actually take a conservative view of what 2022 cash flows were for Incap and just take that number out, it not growing by $1, just taking it straight out. And Incap was actually discounted with 0 growth, if what I've said just makes sense. So it was actually worth less than if it didn't grow at all. And this is a company that has all the tailwinds that I've spoken about and the fundamental tailwinds from regulation, every angle around that we've just spoken about, and growing at 50% per annum, and we could get that for free, all that growth for free. So we found that a compelling opportunity to move into.
Quite incredible, really, when you think about it and the way you break that down. So I found that quite educating myself just to learn about that. And while you've been talking, I've been searching. So it's interesting to have a look at what these companies actually do. So no, well done, and congratulations on what you've been able to achieve in the short period of time, obviously at Blue Ocean Capital as well. Well done. Very exciting. And obviously exciting to all the virtual financial clients to get access to it, more importantly. So these are the sorts of things that we don't know about. And I think, Adam, you mentioned it right at the start, talking about the ability to provide the clients with opportunities that they wouldn't usually get access to. And that's the beauty of the partnerships that you've got, like with Will and Blue Ocean.
Yeah, it certainly is, mate. I mean, that's what it's all about, is to give our clients the options to be able to invest like the rich and wealthy do, and to invest in great products. I mean, like, just the information today from Will in regards to those 5 or 6 companies is just, priceless. And to hear how they invest, I mean, there's no way you can do it yourself with all the research that they do. There's a research team, so to be able to have Will and Blue Oceans as an option for our clients is fantastic.
Yep. Well said. Well said. Now, to all of you that have been online, if you've got any questions, please drop them into the Q&A. Yep, the Q&A is there as I check it. So I will moderate that and pass on any questions that we've got to Will. While anyone may be typing a question in, mate, I've got one for you, Will. And I probably mentioned it at the start as well, with things like artificial intelligence as an example. What's your thoughts on that? It's obviously making... I know it's been around for a while, certainly in the medical field, the robotics field is quite big. You can only see it getting bigger. What's your thoughts on it?
Yeah, well, I think it's tremendously interesting. I think Bill Gates' comments were kind of telling when he said, this is going to be one of the most transformational technologies of our time. It's potentially a play for people to think about buying Microsoft. Microsoft is a terrific business, a terrific franchise, excellent sort of dividend yield and whatnot, and it's actually at a reasonable price right now as well. And it's something we've given some thought. Will it be monetizing it is where I'm sort of thinking. How will that be done? I'm not sure, but I think for Microsoft and what they've said, they only need to take a fraction of search from Google, and it will just be enormous to their bottom line. And I mean, I've been using it a little bit, and I find what you can do with it compared to just search on Google search it is operating in its own niche. It does have a purpose, it could be compelling. But that's about the scope of my knowledge of ChatGPT.
I was at the Melbourne GP yesterday with a family from the Gold Coast, actually, up in up in Brisbane. She's doing a master's in psychology, and we got talking about AI and ChatGPT in particular. And she said it's quite incredible that I put some very, very specific details into ChatGPT, and the paper that it wrote with the detail that it had was just incredible. It would have taken her 3-4 days, maybe even a week, to write to that level of detail, and it just picked up the information incredibly well. So you're right, the monetization is going to be interesting to see how they do monetize that. And does Microsoft own it, or are they just a significant investor?
I think they've got rights to it. Yeah,
I think they have. I think they bought the rights, haven't they?
Yeah, but I mean, that ChatGPT and what's it called, OpenAI. I mean, that'll just be one. The technology will go to other holders as well, I suppose. But yeah, the ability for Microsoft to scale it would be, second to none. Yeah. Well, considering Google's one hasn't performed so well to date, I'm sure they'll get it. They'll get it better. But yeah.
And I think from memory, the founder was Elon Musk, wasn't it? One of the founders.
Yeah, something to do with that. Well, yeah, he might have got OpenAI off the ground somehow. Yeah, or donated to it. Yeah, I'm not sure.
Yeah, something like that. I can remember reading about it. I went, really?
Yeah.
He's got a lot of fingers in a lot of pies now, which gives him the ability, I suppose, to do so much. So, which is brilliant. Now, questions. We don't have any.
That's easy.
Any that you want to know, please let me know. Please drop them in. We've been going for now 40 odd minutes. So it's fantastic. So anything you want to know, ask away. Obviously, you've got the virtual financial team as well, whether it's Leslie, Rod, or obviously Adam here as well. So they're only a call away to for any sort of questions you may have as well. So Adam, any sort of parting comments before we let everyone go?
Yeah, thanks, mate. I think for our clients that are listening to this or watching this, it's just important to realise that, this is for wholesale investors, it's a unique investment. You really need to get the right advice. So to make sure they come along and speak to myself or Rod or LJ in regards to the investment. Obviously, it sits in that kind of alternative investment space. but a fantastic opportunity for our clients, and I really hope that a lot of clients will look at this.
We're allowed to talk about minimum investments.
Yeah, sorry, the minimum investment is $50,000 for our clients. So it can be through their, through their self-managed super fund or direct as an investment, or through their trust or company. So generally speaking, with this sort of investment, wholesale investment, you need to have about $500,000. But with our dealer group Chartreux, they've struck a deal with Will where our clients can invest with as little as $50,000. So it gives them an opportunity to, test the water if they want to, and see how, I suppose, other people invest.
Brilliant. Will Simpson, any parting comments, mate?
No, I think that's been great. I think we've covered a lot of the core topics, which I wanted to hit on. Look, people can find me at blueoceans.com.au. They can give me a call about any of their investing questions they might have. Happy to have a discussion with any virtual financial clients.
I was going to say we had a late question come up, but it just says thanks, Rod. No, always good. Thanks, Will. And look, to all of you that have been the last sort of 42 minutes been online, if you've got any friends or anyone that you'd like to sort of tap into this as well, we are running a session tonight. So we're going to have another session with Will at 6 p.m. I think everyone had the opportunity to take the 12 p.m. or the 6 p.m. We've got a huge amount of people joining us at 6 p.m. tonight. So, and now that we're all on the same time zone, how good is that?
Fantastic.
We've lost our daylight saving in Melbourne, but that's all right.
Yeah.
Will, thank you. Adam, thank you. To all of you that have joined us as well, thanks for joining us. Signing off till we see you next time. Thanks again.
Thanks, Paul. Well done, mate.
Thank you. Bye-bye.